I am Sally. Welcome to Sally Krawcheck Retired. And today I'm going to talk about something that is quietly costing American retirees over $1.7 billion every single year. Not because people are reckless, not because they do not care about their money, but because they have an IRA and they simply do not know the rules. And here is the thing. The IRS knows the rules very well, and they are absolutely ready to collect a penalty from anyone who gets it wrong. So let us talk about the most costly IRA mistakes that real retirees are making right now in 2026. I am going to keep this fast, clear, and genuinely useful. No boring lectures, just the stuff you actually need to know. Mistake number 1, missing your RMD. And this one has a brand new update that most people have not heard about yet. RMD stands for Required Minimum Distribution. If you have a traditional IRA, the government does not let you keep that money sitting there forever tax-free. At some point, they say, okay, time to pay your taxes. That age used to be 70 and a half. Then it moved to 72. Then Secure 2.0 moved it to 73. And for people born in 1960 or later, it is going to move again to 75 in 2033. So right now in 2026, if you turn 73 this year, you must take your first RMD no later than April 1 of 2027. Every year after that, the deadline is December 31. Simple enough, right? Except here is what the research actually shows. According to Vanguard data, around 6.7% of their clients who were old enough to take RMDs took absolutely nothing in 2024. Zero. And the average amount those people should have taken was $1,160. Now here is where it gets painful. The penalty for missing your RMD is 25% of the amount you were supposed to take. 25%. On $1,160, that is a $2,900 penalty. Just gone. For doing nothing. Now there is a small silver lining. If you catch the mistake and fix it within 2 years, the penalty drops to 10%. But still, that is $160 you never needed to lose. The fix here is genuinely simple. Set a calendar reminder every year. Know your RMD amount. Take it before the deadline. Do not let the IRS remind you first because their reminder is a bill. Mistake number 2, wrong beneficiary on file. And this one is not just costly. It can be heartbreaking. Here is a real situation that plays out more often than most people realize. Someone gets divorced 15 years ago. They remarry. They love their new spouse deeply, but they never updated the beneficiary form on their IRA. They pass away. Their ex-spouse gets the entire IRA. Not their current partner, not their kids, their ex, because the beneficiary form is a legal document, and whoever is named on that form gets the money. Period. It does not matter what your will says. It does not matter what your family expects. The beneficiary form wins every single time. The fix takes about 5 minutes. Log into your IRA account today. Check who is listed as your primary beneficiary and your contingent beneficiary. If anything is wrong, outdated, or missing, update it right now before you close this video. This is one of those mistakes that costs nothing to fix in advance and can cost everything if you ignore it. Mistake number 3, ignoring the inherited IRA 10-year rule. And this one is creating massive surprise tax bills for families right now. If you have an IRA and you are leaving it to your adult children or other non-spouse beneficiaries, they do not get to stretch those withdrawals out over their entire lifetime the way beneficiaries used to. The Secure Act changed that. Now, most non-spouse beneficiaries have exactly 10 years to empty the entire inherited IRA. All of it. Within 10 years. And here's the tax trap that nobody talks about clearly enough. If your child is 50 years old and still working and they inherit your $400,000 IRA, they are going to have to pull that money out during their peak earning years. Every dollar they withdraw gets added to their regular income. If they are already earning $120,000 a year from their job and they start pulling $40,000 a year from your IRA, they are now in a much higher federal tax bracket than they expected to be. The tax bill can be genuinely shocking. And the inherited IRA itself is now empty in 10 years instead of lasting decades the way it would have under the old rules. The way to address this is to think now about whether a Roth conversion during your own lifetime makes sense. Money in a Roth IRA is still subject to the 10-year rule for non-spouse beneficiaries, but withdrawals from an inherited Roth are completely tax-free. That difference is worth understanding clearly before your family has to deal with it. Mistake number 4. Pulling money out early and not understanding what you owe. If you take money out of a traditional IRA before age 59 and a half, you are generally going to owe 2 things. Your normal income tax on the withdrawal amount, plus a 10% early withdrawal penalty on top of that. So if you pull $20,000 out at age 55 and you are in the 22% federal tax bracket, you owe $4,400 in income tax plus $2,000 in penalty. That is $6,400 gone on a $20,000 withdrawal. Now there are exceptions. If you use the money for a first-time home purchase up to $10,000 lifetime, the penalty goes away. Certain medical expenses above the AGI threshold, disability, health insurance premiums while unemployed, birth or adoption up to $5,000 per parent. These exceptions exist, but you have to know about them and document them properly. The mistake most people make is pulling money in a genuine emergency without first checking whether they qualify for a penalty exception. A quick conversation with a tax professional before you take that withdrawal can save you real money. Mistake number 5. Leaving your IRA money sitting in cash and calling it investing. This one surprises people, but it is extremely common. Someone opens an IRA. They fund it. They feel proud of themselves for doing the responsible thing, and then they never actually invest the money inside the account. It just sits there in the default cash position or a money market fund earning almost nothing, and they think they are building retirement savings when really they are just parking money in a slightly special bank account. An IRA is not an investment, it is a container. The investments go inside the container. Stocks, bonds, index funds, target date funds, whatever matches your timeline and your risk tolerance. If you have an IRA and you have never actually chosen what your money is invested in, open the account right now and look. If everything is sitting in a money market or settlement fund, it is time to fix that. Every year that money sits uninvested in retirement, it is not growing. And the cost of that missed growth compounds quietly into a very large number over a decade or two. Mistake number 6, contributing too much and triggering the excess contribution penalty. The IRA contribution limit in 2026 is $7,500 per person under age 50. If you are 50 or older, it is $8,600. That limit applies to all your IRAs combined, not per account. All of them together. If you have a traditional IRA and a Roth IRA and you contribute $7,500 to each one thinking those are separate limits, you have just made an excess contribution. The penalty is 6% per year on the excess amount for every year it sits there uncorrected. If you catch it quickly and remove the excess contribution before your tax filing deadline, you can avoid the penalty entirely. But if you miss it and it compounds, that 6% adds up in a way that feels deeply unnecessary for what is essentially an accounting error. The simplest fix is to know your limit before January 1st and automate your contributions across the year so you never accidentally overshoot. Mistake number 7, not doing Roth conversions during your low-income years before RMDs hit. This is the big strategic mistake, and it is the one with the largest long-term dollar impact for most retirees. Here's the situation. You retire at 63. Your RMDs do not start until 73. That gives you a 10-year window when your taxable income may be lower than it has been in decades. You are not getting a paycheck. Social Security may not have started yet or may be modest. This is the window where converting portions of your traditional IRA into a Roth IRA makes the most financial sense. You pay the income tax now at a lower rate, and from that point forward, the money grows completely tax-free. When you eventually take withdrawals from the Roth, zero taxes. And Roth IRAs have no RMDs during your lifetime, so you are not forced to take money out on the government's schedule. The people who use this window wisely are the ones who arrive at age 73 with a smaller traditional IRA balance, lower forced RMDs, lower Medicare premiums because their income is lower, and a growing Roth account that will serve them and their family completely tax-free. The people who ignore this window arrive at 73 with a massive traditional IRA, large forced RMDs pushing them into higher tax brackets, potentially triggering IRMA surcharges on their Medicare premiums, and no tax-free pool to pull from when they need flexibility. The Roth conversion window between retirement and your first RMD is genuinely one of the most powerful financial planning opportunities available to any retiree, and most people let it pass without using it because nobody explained it clearly enough before it was too late. Now here's one more update that is brand new for 2026 and directly affects your IRA strategy. The One Big Beautiful Bill created a new $6,000 federal deduction specifically for Americans age 65 and older with income below $75,000 as a single filer or $150,000 as a joint filer. Married couples where both spouses qualify get $12,000 in additional deductions. This reduces your federal taxable income before you even start thinking about your IRA. But here's the piece most people are missing. This new deduction phases out as your income rises. If your traditional IRA withdrawals or RMDs push your income above that threshold, you lose part or all of this deduction. That means the amount you withdraw from your IRA is directly affecting how much of this new senior benefit you actually get to keep. This is exactly why thinking about your IRA withdrawals as part of a complete income picture matters more in 2026 than it ever did before. The rules are more connected than they used to be, and the cost of not understanding those connections is real. Here is the summary of everything we covered today. Missing your RMD costs you a 25% penalty on the amount you should have taken. Wrong beneficiary on file can accidentally give your IRA to someone you never intended. The inherited IRA 10-year rule is creating surprise tax bills for families who were never warned about it. Early withdrawals before 59 and a half usually mean income tax plus a 10% penalty unless you qualify for an exception. Leaving IRA money in cash instead of actually investing it costs you compounding growth every single year. Contributing more than the annual limit triggers a 6% excess contribution penalty, and not using the Roth conversion window between retirement and your first RMD is the biggest strategic mistake with the longest-lasting financial consequences. None of these mistakes are complicated once you understand them, but every single one of them is expensive if you ignore them. And the good news is every single one of them is fixable or completely avoidable with the right information at the right time. If this video gave you something genuinely useful today, please hit the subscribe button for Sally Krawcheck Retired right now. And tap that bell icon so you never miss a new video. Every single week, we cover the retirement topics that real Americans actually need to hear, with real numbers, clear explanations, and zero boring filler. If you have a friend or family member who has an IRA and you are not sure they know all of this, do them a real favor and share this video with them today. It could save them thousands of dollars. Drop a comment below and tell me which of these mistakes surprised you the most. I read every single one.